It's no secret to those who know me or those who have ever participated in my training to know that I prefer for people to understand not only the simple steps or the one, two, three of how to do something, but also a little bit of the theory or concepts behind it. That is no more true than with the use of QuickBooks. I know a lot of people who have absolutely no formal bookkeeping or accounting experience, but who use QuickBooks very effectively. Behind the scenes, QuickBooks uses accounting principles, and if they are understood, we can not only better appreciate all that QuickBooks does for us, but also troubleshoot and utilize its features more effectively. For those reasons, we're going to go through a little accounting primer or accounting 101. Now, don't worry. This will only be several minutes, but it will be enough of an overview to give you the insights you need, but not anything close to a full 16-week accounting course. With that said, please remember that first of all, I am not a certified public accountant nor a professional bookkeeper. I'm an entrepreneur, a business owner, and an instructor. What I am presenting are some basic concepts that I think are important for QuickBooks users and that I have learned myself over my many years of working with QuickBooks. It's important that if you do not have a strong foundation in accounting or bookkeeping, that you consult with an accountant or a tax attorney who can help you make the appropriate choices for your specific business. This should never take the place of that type of professional advice. So, of all the things we can know about accounting, what do we need to know? When we get started with QuickBooks and realize that it forces us to do things in a certain way, it's important to understand that the reason for this is there are certain sets of rules called Generally Accepted Accounting Principles, or GAAP. These are not some haphazard or fly-by-night rules. They are actually defined by industry professionals. It's important to know that while laws for accounting and certainly for tax preparation can change, the basic principles of accounting do not change. GAAP does not change, ever, no matter what business you're in, no matter how large your company is. These principles ensure that our methods provide information that is easily recognizable, standardized, and accurate. QuickBooks follows GAAP principles and does things like requiring us to enter a vendor onto a vendor list before we can write a check for that vendor, and to categorize transactions using a chart of accounts. Now that segues into one of the very first things that students learn in their first bookkeeping or accounting class. It is the concept of double entry bookkeeping. I know it's enough to make some people's eyes glaze over, but the concept is actually very simple. It's like keeping a balance on a scale. Every transaction must have two entries. If you receive income for something, it's because you sold something, and therefore two entries must be made. One for the income from the sale, and the other showing that your inventory has been decreased. This is how accounts remain balanced with one another. It's also why we have a report called the balance sheet that summarizes how all of our accounts remain constantly in balance. This is one of the primary reports that QuickBooks can generate and that entities like a bank or investors might want to see if you're ever trying to get financing for your business. These accounts that we're talking about are kept in a chart of accounts, or COA. The chart of accounts is a core feature of any bookkeeping system. The chart of accounts is simply the complete list used by a company to define each category or classification for which money or value is received or expended. Yes, I know that's a technical definition. Each account is a unique record for each type of asset, liability, equity, revenue, or expense that the company incurs. Everything that comes into or goes out of the business must be attributed to an account. That's how that balance sheet works. As we've mentioned many times, things can't just magically appear or disappear. This is especially important when it comes to small businesses, and especially those where owners or sole proprietors may contribute money or take out money from their personal accounts. Because QuickBooks follows GAAP, you can't just have, let's say, $1,000 suddenly appear in the company's bank account. It must be attributed to something. In this case, it will probably be attributed to an account known as owner equity, monies that the owner puts in. The good news is that a lot of this happens behind the scenes, but it's important to know that everything we do in QuickBooks must be attributed by either adding or removing, in other words, crediting or debiting, accounts from the chart of accounts. So let's take a step back for just a moment, considering what we already know. As we're writing checks or creating sales receipts in QuickBooks, we're actually making entries into accounts on the chart of accounts and actually using something called the general ledger. Generally speaking, for each activity, we are also crediting one account while debiting another. This way, the accounts always remain in balance. All of this happens through the basic principles of double entry bookkeeping and generally accepted accounting principles. How then is the chart of accounts created or modified? Well, first of all, each business should personalize their chart of accounts so it contains only the accounts that the particular business needs. This means that you should remove accounts that you do not need or use, as well as create accounts to specifically classify your transactions. As an example, I am a trainer and instructional designer. That's what my company does. Therefore, my company does not need to track anything for inventory. In 20 years, we've never carried inventory and have no intentions of doing so. On the other hand, we have very specific types of income that we want to track. One would be for the presentation of training, live instructor-led training, if you will, and another would be for the services of instructional design. We even have a specific income account for creating and receiving income for these types of instructional videos, known as computer-based training or CBTs. Your business should also make sure that your chart of accounts contains the types of accounts that you need to track the kinds of income and expenses that you may have. Now, these accounts can be created in one of three ways. They can be created during the initial setup process of the company file. QuickBooks will give you options for setting up the company file itself. There are a variety of options to choose from, and you will select the one that is most appropriate for your type of business. Sometimes accounts will automatically be created based on certain types of entries that we make using different QuickBooks features. This, of course, is easy because automated is always easy. Lastly, you can manually create accounts if you find the need to do so at any point in time. It's always a good idea to leverage the automated options and recommendations that QuickBooks provides as we work. It's good to know, though, that we can modify this at any time as your business grows and your needs change. In this first part of our accounting primer, we've learned that QuickBooks helps us follow good accounting practices and that everything is based on the chart of accounts. In part 2, we'll delve into some specific types of accounts and why they are important.